Almost since the beginning when the Fed started raising interest rates last spring, the market has been obsessed with when these rate hikes will end and what the target rate will ultimately be, something that is referred to as the Fed's terminal rate. Obsessing over the activities and the communications of the Fed is nothing new for the market, of course. But given the historic nature of the current hiking cycle, it's been fascinating to follow. For example, last fall when the Fed appeared to soften its aggressive stance and downshifted from 75 basis point hikes to 50 and eventually 25, investors cheered the news and pushed stocks higher. More recently, before some of the banking issues came to light, the Fed had ratcheted that aggressive language back up, which resulted in stocks giving up some of those gains. What the Fed says, the words they use, or even the words they omit or change from their prior statements all matters to the markets, and the Fed knows this, which creates a catch-22 for them, something I'll come back to in a minute. The big picture purpose of the rate hikes is, of course, to reduce inflation pressures. By raising the cost of borrowing, the Fed hopes to reduce demand and ease pressure on prices. The potential issue is that the cost of borrowing is not the only driver of demand and inflation. When economists are attempting to estimate the impact of higher rates or borrowing costs, they also factor in things like corporate credit spreads, currency exchange rates, and changes in the stock market. They call it a financial conditions index, like the one shown here. The green line is the financial conditions index, and the blue line is the Fed's target short-term interest rate. As the directional arrow on the left shows, the higher the line and number, the more restrictive financial conditions are. The catch-22 for the Fed is that their actions and their communications can end up being offset or even outweighed by changes in some of those other factors. We saw exactly that this past fall. As we know and show here with the blue line, the Fed has continued to hike rates, yet financial conditions between last October and February got easier due to a stock market rally. That was in no small part driven by the Fed communicating that they were nearing the end of their hiking cycle. As a result, the Fed needs to be very careful in what they signal to the market. They may want to be open and transparent, but that can't be at the expense of their primary objective, reducing inflation through the one monetary tool that they control, short-term interest rates. My personal opinion on this matter is that all of this translates to a Fed that has to talk tough and keep the market guessing until inflation is more clearly under control. Doing anything else could be counterproductive. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video.